Hi, you're watching Investor Insights. I'm Vic, and in this video I want to talk about stops. More specifically, keeping stops. Now, a stop, or more correctly a stop loss order, is basically an order that you put into your trading system that triggers an automatic exit when your stock or whatever trade that you're doing hits that level. Now, in this market, it's imperative that you keep stops. It doesn't matter if it's stocks or currencies or bonds, whatever. In currencies, if you don't keep tight stops, and you always hear me talk about tight stops, you can get wiped overnight. It's now very frequent to see yen moves in the 300 to 400 point range within 48 or 72 hours. I've seen the Aussie move in even just this week alone, move in a 500 point range. I mean, a 500 basis point range on the Aussie dollar. I've seen the euro move 250 basis points, basically in the space of 36 hours. And I've seen the pound move just 3 days ago in a 300 point range almost. You gotta keep your stops, especially when you're playing with leverage. Remember, an account that's levered 100 to 1 and a position that moves against you 1% wipes all your capital. I'm talking about FX. Obviously, stock margin accounts aren't going to be that high, but margin stock accounts have their losses magnified when positions just move against you. If you don't have a stop on a margin account and your stock moves against you 10%, your portfolio loss on that position is 30% if it's levered 2 to 1. Even if there's no margin on your account and it's 100% your own money, do you really want to incur 10%, 15%, 20% losses? No. So the most important consideration when you make an investment decision or a trading decision is preservation of capital. The more something goes against you and it eats away at your capital, the longer it's going to take you to get back even. And the more confidence you're going to lose, the more frustrated you're going to be, the more hair you're going to pull out. It's a tough game. But when you use stops and you keep close stops on a lot of your positions, as soon as they start to run against you, you're out, you live to fight another day. That's your one protection against volatility. A lot of people trade without stops. Most of these people get wiped when the market starts to swing wildly. And most of these people put it down to bad luck. Well, it's not bad luck, it's bad management. Keeping close stops, monitoring them, setting good stop loss execution orders, and sometimes moving your stops is the best way to get ahead in this market. Because a stop can be adjusted. You can have trailing stop loss orders. You just move them higher as your stock goes higher. And that's a way of locking in your profits. I mean, if you bought in at 10 and it's now 12, your original stop could have been at $9.50 or $9. Well, now that it's up to 12, you should put your stop at 11. So that if push comes to shove and the stock starts to move against you, you get stopped out at 11, you still bank the dollar profit. And that's smart investing, smart trading. Learn to lock in your profits. using stops, or learn to shield your capital from further losses by using stops when you first enter the trade. We can't be right all the time. Nobody's that smart. Even the world's richest investor makes mistakes. Doesn't matter. We learn from it. But in order to learn from it and be able to execute another trade, we've got to have capital. And again, stop loss orders is the one thing that's going to help manage your money better by protecting your capital, especially when you're taking a hit.